We are in a tough spot here as a country. Jay Powell's in a tough spot. I don't know how we extricate ourselves, and I think the stock market is telling us that every day.
I think you're right, Joe. We have to acknowledge that the reality is tough. And for the markets, it really boils down to the plain and simple is inflation is still rising. Nobody's been great at predicting it, including the Fed. And as a result, they're having to catch up to these elevated inflation with very choppy, I would even say very sloppy policy. I mean, this is why the market cannot find any sort of footing, is because you get one message from the Fed based on one inflation print one week, and then something else happens and inflation ebbs and flows and they adjust quite radically. So against that environment where markets crave predictability, they want a certain path, and the Fed is not giving this to us, is just going to be really hard. So for now, the Fed's reaction function is as long as inflation stays elevated, they're going to continue to get incrementally more hawkish. That's not a recipe for market upside. That's a recipe for market downside, because all things equal, it depresses market multiples. And, a few weeks ago, I thought we could kind of stabilize around the 3,900 level, because that was 16.5 times on forward earnings on the S&P 500. But the trouble with that now, as the market, trades below that, is now, we went from pricing in the rate of 2.6% by February of last year to now 4% by February of last year. So that's been a big move higher in rates. And of course, multiples have to decline as a result of that. So it's tough, Joe.
When we rank bad things for the economy and for the country, obviously people think inflation is number one. Is the most threatening and the most, what's the word I'm looking for? I mean, it's bad and it's worse. Obviously, if you're going to orchestrate a recession, nobody wants a recession, but if you're going to orchestrate a recession to deal with inflation, inflation must really be pretty bad, because you'd never deliberately bring on recession, and that's essentially what we're going to have to do.
Well, inflation is pretty bad. And here's the really challenging part is I think there's a part of inflation that the Fed can contain, but there's a huge part of it that it can't. I mean, if you think about the inflation print last week, it was about food and it was about energy. What could the Fed really do to rein that in? Are we going to cut back on eating? Are we going to cut back on driving? Probably not. So that's really a more structural issue that I think the administration, the fiscal authorities have to address, but that's not currently being done. So I think the Fed is trying to do, what they can control, which is core inflation. And there it's tough too. I mean, first of all, core CPI has started to decline on a year-over-year basis. I think that's a silver lining here. We stepped down from 6.2% to 6%. But if you look at the components moves on a monthly basis, you still see sticky inflation elsewhere. So I think what the Fed is trying to do, since they can't really control the headline, they're trying to make up for it on the core side, and they're trying to hike those rates. So it is difficult. But, Joe, I would make a distinction between a slowdown and a true full-blown negative GDP recession. Maybe this doesn't have to be a GFC scenario, because what makes for a major correction is when you have a number of excess froth that has been built into the system. And yes, we can talk about crypto and unprofitable tech. But when you look at, for example, credit fundamentals of companies, they're in really good shape. When you look at the consumer balance sheets, they're in really good shape. So yes, I think we have a slowdown on our hands to correct this inflation problem, but perhaps it doesn't have to be the deep recession as we've experienced before.